Good afternoon, everyone. Thanks for sticking it out here. Hopefully we'll keep this enlightening and enlivening. So I'll just start off with some brief introductions. Myself, Matthew Pines, I recently joined the Bitcoin Policy Institute as executive director. I was a fellow with them since they got started and decided earlier in this year it'd be really the right time to kind of make the hard pivot away from national security, geopolitical, cyber consulting into Bitcoin policy full time. It's been a pretty crazy environment in DC, which is where we are based, and we're really focused on making America's pro-Bitcoin pivot decisive. And we do lots of rigorous policy analysis, education with policymakers on the intersection of Bitcoin and these larger strategic issues. Importantly, the convergence of AI, Bitcoin, and energy. And this is a topic of which is top of mind inside Washington, D.C., so we're going to talk about that today. First, little quick shill. Folks like talking about Bitcoin and policy, go to btcpolicysummit.org. You can sign up. We're going to be hosting our major flagship event in D.C. on June 25th. So with that shill out of the way, I'll let my panelists introduce themselves.
Thanks, man. Alex Bramer. I run global operations for Bitfarms, publicly traded mining company. We run our portfolios right now around 460 megawatts energized. That'll go to about 1.3 gigawatts in the next few years. Before that, worked at Talon Energy, spun up the first nuclear-powered Bitcoin mine, and then was at Luxor before that. And some of you may know, some of you may not. We're now, what's relevant here to this panel is we're now starting to spin up a business division to build and deploy AI HPC data centers throughout Pennsylvania.
Andrew Myers, I'm CEO of Satoshi Energy. We develop sites for Bitcoin and AI data centers, and we're building software to streamline energy transactions, ultimately using Bitcoin.
Awesome. Let's start, maybe I'll ask kind of the dumb question here, which is how does Bitcoin and AI intersect? It seems like there are lots of subsidiary questions that policymakers would have when you think about the transformation of our grid, different types of load. And so just could you explain, like first off, like how do you assess the difference in terms of the operational characteristics of Bitcoin and AI and high performance computing?
So from a data center operations perspective, let's talk about load flexibility and profile first. Bitcoin, I think in the last 4 years, we've all done a good job of propagating this narrative around, infinite interruptibility, using Bitcoin mining as a grid stabilization asset. I think sometimes the narrative gets a little bit out over the skis of what's happening in reality, but I do think that there are a lot of big companies out there that are doing demand response to the benefit of grids. Now, the other side of that is sometimes the data centers are designed, if you think about in a tiering system, so tier 0 is kind of, think of the chicken shack mining farm that you'd see out in the fields. Tier 4 is kind of a hardened, top secret data center that's run by 3-letter agencies. As you move up that tiering, you get more and more reliability and redundancy built in. And I think one of the downsides of Bitcoin mining from a grid operator's perspective is that oftentimes they build cheap and fast, but with cheap and fast comes less reliability than you would like for the size of loads that we're talking about. Multi-hundred megawatt facilities. If you throw that load because something happens and that drops in a matter of seconds, if it's large enough, or if there are specifics around the node that you're operating in or the specific area of the transmission system that you're operating in, you can actually introduce grid destabilization dynamics. AI HPC data centers, high performance compute data centers, much older industry. Most of them are serving, most big miners are mining proprietarily, and so they don't have a customer to face to meet service level agreement, uptime requirements, availability requirements, which allows them to build cheap and fast. But it also introduces that reliability risk. The high performance compute data centers typically have counterparties that they have service level agreements that are tied to, $10, $100 million contracts. so that enables them to build more expensively. They've got more redundance, and they are generally going to be more reliable. And again, just the technology stack is much more mature. Traditionally, those loads have been more stable as well. Like there's a little fluctuation, but with that stability comes, because of the contractual requirements, there's no interruptibility. You're not going to interrupt an Amazon data center because they've done the math and they realize that every millisecond that you have to wait once you click buy now, you're likely not going to, is decreasing the probability you return to the site. Now, I think where they intersect, I think the thing that everyone is thinking about is how do you bring the upside of the interruptibility of Bitcoin mining into the high performance compute data center such that you are still able to allow these hyperscalers and AI neoclouds and all these folks to meet the SLA requirements, but also be grid stabilization assets. And this is only becoming relevant, I think, in the last few years as these high-performance compute data centers are starting to reach the scale that Bitcoin miners started to reach 4 or 5 years ago. There are pockets of them, but now, like, when you look at load growth profiles for the next 3 years, we're talking, I've seen some upwards of 60 gigawatts just in the United States. Up from single digit today. Those are going to become much more material, both risks if they're not managed correctly. So specifically from like independent system operators, they are starting to look at these and get nervous. AWS bought the Talon data center campus at the nuclear facility in Pennsylvania. It's 960 megawatts. That won't all be built out at one time, but in the next 3 or 4 years, that will be a gigawatt of high performance compute on a single node in a single region in Pennsylvania. And so the technology and the methodology transfer from Bitcoin miners over to high performance compute data center operators, the HPC guys are looking at us and they're going, all right, well, how do we start to integrate that? It's going to become much more technologically robust and there's all kinds of reliability concerns. But I think that's one, grid stabilization and HPC as an asset. There's one, critical area of overlap.
Give your thoughts as well.
I kind of have a question for Alex. How do you see HPC data centers providing flexibility and grid reliability?
So I think backup generation. So when you buy backup generators, you can buy different classes of backup generators. So there's kind of data center rated, and then there are what are called prime rated diesel gen sets. So think like Rolls-Royce, Generac is starting to build them. There's a bunch of different providers. You'll start to see, and I think like at some point maybe we'll get here, but I think the regulators and the independent system operators and the utilities will actually start to force this for permitting. You'll see them getting primes. And prime is really just like what's the rated amount of time that they can run per year into, in between maintenance cycles, et cetera. So you'll probably start to see it where, telemetry will be sent. Grids will be able to read telemetry of data centers. Data centers will be able to receive signals from grids. They'll get signals around 4CP here in ERCOT, 5CP in PJM. And they'll actually the automated transfer switch will just switch everything over to the backup gen set, not in an emergency response profile, but in just a grid stabilization profile. That also requires you to overbuild your UPS systems. Like there's a whole bunch of power management and infrastructure that is layered in between that. But I think that we're going to start to see the utilization of backup generation for primary power production in non-emergency situations will be one.
Yeah, I tend to agree with all that. We're seeing the same thing. One of the bigger challenges right now is that if you're a utility or a grid operator and you're trying to forecast load growth, the way they're doing it now is they're looking at the peak demand across all of these data centers and they're not accounting for the flexibility. So Bitcoin data centers are clearly flexible. They're price responsive in a market where they can be price responsive, and that should be part of the load forecast. And then you have AI HPC data centers, as Alex said, bringing their own backup power generation. That backup power generation can be utilized when demand is high on the grid, and therefore your long-term load forecast doesn't need to say, demand's going to double in ERCOT in the next few years, and therefore we need to build out all this new transmission and substation infrastructure. It can be managed through energy prices, through a market, which is how everything else works. The other thing we think about a lot is just site development. So what are some of the characteristics between Bitcoin and AI data centers, and what are they looking for? Bitcoin data centers being much more flexible, and they can locate pretty much anywhere, require less bandwidth and latency in their fiber connections, typically less water requirements, less labor requirements, and then you get an AI data center company that's interested in finding a site, and they have much more stringent requirements there, so they're not as flexible in where they can locate. That said, I think a couple of years ago, AI data centers were generally opposed to kind of West Texas, these remote parts of Texas, and then there was the big Project Stargate announcement, and I think just kind of seeing proof of it being done, a lot more AI data centers are actually starting to go out there and locate. And maybe the labor force is developing out there. Maybe people are building out more fiber and connectivity. That could be a part of it. But I think it was also just like seeing somebody else do it that made it happen.
It's also the type of compute they're processing too. Like if you think about it in tranches, there is the kind of cloud service provision that is very, very sensitive to latency. So that's why you see these data center hotbeds. There's Dallas, Virginia, Phoenix. They're located in these regions where, Virginia serves New York, but there's also ones up in New York as well, where that latency is really important. Then you get up into inference, which, depending on what forecast you want to interpolate from, inference will be roughly, call it 10 to 40% of the amount of compute that's being used in the new AI paradigm. That is kind of moderately sensitive to inference or to latency. So we're all conditioned here. Like I think most of us, even if we don't want to admit it, we use ChatGPT or some other LLM as a search engine or as a research tool or as a writing assistant. We're kind of conditioned where you input a prompt and you're waiting for a couple seconds and you're not kind of sitting there. Like you already expect that because you kind of in your mind, you're like, okay, well, it's got to go process this. And then it spits out whatever the answer is. Less sensitive, that competition in that space will heat up and that latency will become more of an issue, but I don't think it's ever going to be as, it's not like high frequency trading on Wall Street where milliseconds cost, billions of dollars. Then there's foundational model training and fine tuning and post training. These are the ones that I think are primarily driving the demand in very remote areas where there is substantial latency relative to being in these core markets where you just hit go and it's running training for weeks, if not months on, hundreds, thousands of GPUs. That's not like you load your training data set there and it's just churning through that. And everything is happening within, all the GPUs in the data center are very heavily networked and there's very high latency concerns, but ingress egress is not as important. And so the other thing is the other overlap here is that a lot of Bitcoin miners are sited in areas which historically have been useless to high performance or to cloud data centers essentially. Now that locational requirements are less important, it's opening up, it's turning eyes towards these more remote data center locations for these hyperscalers, for AI data centers to say, okay, well, 2 years ago, 3 years ago, I couldn't even look at that, but now there's a shit ton of power. They're not really concerned about power costs because the margins are so high, but I can locate there because that's the quickest time to energization.
So given that, to what extent do you think right now are Bitcoin mining operations, especially these industrial scale sized operations and frontier AI model training, are they rivals for the same electrons? And to what extent are they evolving to be more complements?
It's getting a lot more competitive in my view. We have some sites that we've developed over the last few years where maybe we initially sold it to a Bitcoin data center and then they flipped it and sold it to an AI data center company, for example. It's interesting to see how it will play out. It's hard to predict like kind of exactly where there's such a scarcity of power capacity right now that the people investing in AI are going to continue to be super aggressive on finding power capacity to power AI. But in the same idea, like people are very aggressively trying to accumulate Bitcoin right now, even at the nation state level. So there's a lot of fiat money going into both markets, and they're both pretty well funded to grow.
Well, from the perspective of the grid or the power seller, from your experience, how do they view the reliability of the contracts themselves, right? With a Bitcoin mining operation, hash price of Bitcoin, modeling that in is very different than trying to model in future demand for from these AI operations where they might engage in a certain contract up to a period of time, but there's a lot of seems like a perception that may be a lot of build out that may not actually turn a profit in the next few years on the AI side.
So from an underwriting perspective, a lot of these, I'll say right now, grid operators, utilities, they view Bitcoin miners very suspiciously. Everyone you talk to has been burned by a Bitcoin miner, going out of business, violating a contract. That's why collateral requirements for Bitcoin miners are almost across the board higher than for traditional, large loads. That comes down to creditworthiness, where AI companies, particularly, let's think there's the hyperscalers. Those guys are infinitely underwritable, and anyone that has a contract from a hyperscaler, which are typically on the order of 10 plus years, those are the dream contracts for any data center developer that's going out to build. It's to lock in a contract with a hyperscaler because those are the highest creditworthiness in terms of underwriting, which then translates into lower cost of capital, lower collateral requirements, lower working capital getting tied up. Where you start to get out onto the long tail, a lot of the co-location data centers that are typically doing a data hall or less, so you've got multi-tenant facilities. There is a explosion in capital being deployed in AI right now. You've got a substantial amount of AI startups who are using compute. Those are ones that I would say have the same creditworthiness as a Bitcoin miner. And so as those start to propagate and penetrate into the market more, I think AI data centers, depending on who your contractual counterparty is, actually start to look from a risk profile perspective a little bit more like Bitcoin miners. Because if you're relying on, everyone wants, the reason why proprietary Bitcoin miners are so thirsty to go out and get these large scale HPC contracts is that we all want long-term stable cash flows. We want annualized recurring revenue that is contracted out 3, 5, 10, sometimes 15 years, because our investors want that. It lowers our cost of capital. As that pool of compute becomes absorbed by the largest players, typically with the largest sites, with the most attractive HPC qualities about the sites in the right locations, and Bitcoin miners continue to try and hunt this, they're going to start to engage in counterparty, in agreements with counterparties that are less creditworthy, and there's going to be blowups. So they're going to lock in big sites. They're going to think they have long-term contracts, and then all of a sudden that AI data, that AI startup is just going to go away. The money flowing in from those contracts is going to dry up in a bankruptcy court, and so that risk premium will start to accrue onto that that longer tail. But I also think just the proportion of compute on that long tail is always going to be very small, because the hyperscalers that are engaged with in various commercial arrangements with the largest foundational labs are always going to have 60 to 80% of the compute, and maybe that's even conservative.
So thinking about the integration of Bitcoin mining with AI training, that seems to be this emerging frontier. Maybe it's more theoretical, but I'm curious to hear any insights as to what that looks like now, but also where it might be going. In particular, as these sort of mega sites get built out, hundreds of megawatts, maybe even gigawatt scale, to do frontier model training. There's a lot of variability in the demand profile associated with training these large language models. Of their on-site generation capacity is not going to match in real time that compute load. So how do you see Bitcoin mining potentially integrate with kind of in a vertical stack, those AI training operations, and what sort of new software or new sort of operational capabilities will Bitcoin mining, have to demonstrate to sort of fit into that niche?
I think Alex might have a lot more to add on the operational side there, but from a project financing perspective, it's been interesting to see recently these companies that might have been pure play Bitcoin miners and then started to dabble in the AI space. they're starting to bifurcate their businesses to where it's like purely an AI business and then purely a mining business. And I think one of the bigger reasons for that is because they need capital, and the capital requirements on the AI data center are 10 or 30x higher than on the Bitcoin data center. And maybe they're a public company too, and kind of the perception in public markets, they want to keep those things separate as well. So I don't know how much is really going on in the same data center facilities, and how many projects will get financed that are sort of this hybrid model.
Yeah, that's exactly right. I mean, it's an investor preference, and it's a cost of capital question for sure. On the financing side, on the technical side, this is the holy grail right now for Bitcoin miners that are building high performance compute data centers, because theoretically it just makes so much sense. You've got wild swings. Like when you're doing a training run, you can see 35 to 50% swings in load in sometimes within seconds. As a model goes and checkpoints itself, it's gonna ramp down and then it'll ramp back up. It's very jagged. Inference is a little bit more stable, but there's still quite a bit of variability. And you also just have lower load factors. So your critical IT capacity, like let's factor in your PUE, averaging maybe 70-80% load factor relative to what you have on site capacity, and that's very it almost looks like power markets, the inverse. So the dream is we take mining as this infinitely flexible load, and we basically just do valley filling exercises. So now that briefs well. There's a couple challenges. One, I was listening to a panel earlier today, and Mario was talking about the reliability requirements that upstream oil and gas guys have. So anything that threatens the ability for that oil well to produce its primary revenue generating resource that company is built on is looked at very skeptically. It's the same thing. Another question earlier today was like, why haven't big power producers, like independent power producers, gotten more into Bitcoin? Because like from an engineering perspective and just a raw financial perspective, it just makes too much sense. Like use these things as load sinks, and they're revenue producing load sinks. It's a risk thing. So they can't risk like integrating critical systems in a way where the ancillary system of Bitcoin mining that's used as a kind of ancillary revenue source could threaten their primary business model. On the technical side, you have to take like power management in HPC data centers makes power management in Bitcoin mining data centers look somewhat rudimentary. Like you've got in-band power management, you've got out-of-band power management, you've got power scaling, you've got all types of frequency regulation. You're doing it on the core network, you're doing it on ancillary networks. So when you tie in a Bitcoin mining facility on the same downstream electrical distribution system, you've got to somehow have the software platforms and systems that are running power management for the HPC data center talk to the power management platform, load, foreman, whatever you want to use, the firmware itself. You have to have them talk back and forth. You have to have them talk back and forth reliably, and you have to have the response time and the ramp rates of the miners be able to match the volatility in the HPC load. I do think as more and more Bitcoin miners get further and further in their development and operational excellence programs for HPC data centers, the opportunity set is going to be so large that some will start to try it. What further frustrates that, though, is commercial. This gets back to kind of business risk. The commercial agreements, like if you're doing a turnkey lease, so you build a data center, you fit it out with mechanical, electrical, plumbing, you lease it to a hyperscaler or a colo, whoever it is. As soon as they take the keys to that thing, they're not going to let you do any of this. Like they're just not going to do it. So it's going to be the ones that are actually building and becoming GPU cloud service providers. So these AI neo clouds, the ones that are doing that proprietarily will probably quietly also start to try and integrate Bitcoin mining in as the load filling technology. So I think it's technically possible. I think we are good at we're good at following signals from grids, and we're price responsive. So meaning we're price responsive, which means we have to move fast, especially if you're doing ancillary services in ERCOT. So the technology exists. It's integrating the platforms that is, I think, a heavy lift.
So where do you see this going in terms of behind the meter versus grid connected for Bitcoin miners at AI? These seems to be two exponentials, right? If you look at the just the curve of the hash rate, and then these projections in terms of the build out, right? That's projected for AI. Those two exponentials are running up against a legacy infrastructure that doesn't handle exponentials very well, has not faced exponentials. It hasn't really even faced, above maybe GDP growth since World War II. So just stepping back, right? Sort of the macro question, where do you see these two things colliding? And how do you think that, policymakers and folks that manage grids are ultimately gonna manage their way through this, or how should they?
I think right now, man is building machines, and machines will build machines, and the machines will build power generation, and the machines also won't care what a politician says. So that's a bit maybe high level, but
AI take the wheel.
we're already at this point where regulation has slowed down energy growth significantly, and we're never going to get to abundant, low-cost, sustainable energy in the current regulatory regime. So you have people already building off-grid, small modular nuclear reactors, other types of power generation, and powering their data centers that way. What they would prefer is to actually be in a market where they have optionality, so they can sell some of that power in, or they can have redundant power supply. But again, with the regulatory burden right now, if the AI can't get the data or the energy that it wants, and if Bitcoin can't get the energy that it wants, then it's going to find a way to get it. And if it's a very powerful AI, again, they're not going to care about politicians.
I'm glad that we got to the AI alignment part of this discussion. Just from a regulatory, so the concept of behind the meter is, we think of very binary, front of the meter, behind the meter. It's actually there's many gradations in between. If you're behind the meter, but you still have a physical tie into the transmission system that goes beyond the meter. So maybe your metering is done elsewhere, but that's basically just a financial calculation. But if the electrons can flow back and forth, you're really not behind the meter. So data center companies that are trying to do this, and there's one very large data center company at a nuclear power plant that's trying to do this, that has created a challenge right now that is running its way through FERC and PJM and a bunch of different utilities up in Pennsylvania. You want to be behind the meter because you avoid transmission and distribution costs. They make a case that their internal campus transmission is not regulated by FERC, so you kind of strip away one layer of if you're not in ERCOT. For you ERCOT folks that are sovereign, I'm jealous. But you want to stay physically tied to the grid because that means that you don't have to true behind the meter is what's called islanded configuration. So when you're running a data center that is connected to a power plant and there is no support from the surrounding transmission system, you're running in what's called islanded mode. To do that with inertial generation, so think any type of thermal generation, nuclear, is quite difficult because you have to load follow very closely, or else you'll trip the frequency protection devices on these generators and you'll trip the generator offline. And so that becomes a very difficult technical challenge that requires a substantial amount of batteries. There's all kinds of CapEx required with that, which is essentially what you're paying for with transmission and distribution costs. That is essentially what the grid is doing for you, is it's abstracting away all of that engineering and operational complexity by giving you the training wheels of being on the grid. What I think is going to happen before the AI takeover is the enterprising folks that see the wild revenue opportunity that is coming from AI, the AI boom, which there's various kinds of debates on whether we're in a bubble or not. But if the projections are correct, the revenue opportunity is you can't ignore it. It's also going to justify the build out of islanded generation, which Nick Gates knows a lot about this, sitting up in the front row. You'd build islanded generation. Yes, you still got to go get Title V permitting. There are some challenges and some regulatory overlay there, but you have jumped the queue on the grid. So you don't have to wait for load studies. You don't have to wait for transmission build out. You don't have to wait for some utility to go off and do a project study for 6 months and come back and tell you've gotten rid of all of that. And the profit incentive is so strong right now that it's going to justify paying $1.4 to $1.6 million to build out reciprocating internal combustion engines I mean, I'm hearing upwards of like 2 to 2.2 million for turbine buildouts now. Now the constraint there, so people are thinking about doing that. They're issuing RFPs for doing that. Some people have already broken ground to do that, and they're going to operate in an islanded configuration. They're going to back it up with a shit ton of batteries, and they'll figure it out, and it will work. The constraint there becomes supply chain. It's like you talk to GE, you talk to these big turbine manufacturers. Getting in now the queue has gone from the transmission operator or getting the load study to, can I get in line and how do I cut in line to get the next batch of turbines coming out of GE? But they will do it. They are doing it. They will do it, and it will continue to grow that islanded configuration.
So I think that works for the economics of AI and AI data centers. Do you think it works for Bitcoin?
Absolutely not. Not a chance. No. And I don't think it ever. I don't think. Bitcoin, like to the extent that a lot of the big publicly traded miners start to enter into the HPC space, they will keep, I think some of them will just jettison Bitcoin altogether. I think the smarter ones will keep a portion, like everyone's kind of talking about portfolio management as the approach of managing, multiple data centers. They'll keep a portion of their portfolio dedicated to Bitcoin mining really as just a real call option. And that those will be in the places that could not be built out for HPC or just have really, really low cost of power, and keeping the option alive on that really low OpEx site just makes sense, and they keep exposure to it. And there will be periods where hash price will spike, but I don't think that's I think hash price in dollar denominated terms is pretty much down and to the right forever, which kind of suggests why all the big miners are moving towards HPC, because it's the new shiny thing and there's contracted revenues and all this other stuff. And it also kind of should be bullish if we can solve the pool centralization problem that they talked about on the last panel. It is actually bullish for decentralization of mining, because mining is going to continue to be that pioneer species that goes out into the places that are not, it's stranded energy that is not useful for anything else. Typically that means it's the cheapest. And it's not going to be consolidated in places like the United States, except for, I think I'm super bullish on flare gas mining. I'm super bullish on really low uptime PPAs with, post-tax credit, renewable generators, a variety. I think heat recapture is going to continue to be a really valuable, the movement of mining into the hydro, like direct-to-chip liquid cooling for mining is making heat exchange efficiency much higher, which is opening up new opportunities to actually monetize the heat, which when you net that against your power costs gets you really, really low power costs. We're doing that a little bit in Canada right now. And I also think mining, so waste heat utilization for process heat improvement will be big. So we're doing this at one of our power plants where we're actually building a hydro skid with a heat exchanger into the intake manifold for one of the boilers. And it reduces OpEx, increases reliability. But I think like large scale mining on grid its days are numbered.